750 million ounces. Pause on that number for a moment before anything else is said. Not speculation, not rumor, not an anonymous trading desk leak. A position built slowly, methodically, across more than a decade inside the silver market. By the same type of institution that once dominated the opposite side of the trade. For years, the silver futures market operated under a structure where massive short exposure acted like a ceiling. Every time price momentum tried to escape higher levels. Today, official exchange reports tell a very different story. On first notice day for the March delivery cycle, 12 million ounces of physical silver were claimed in a single session, through the CME Group's daily delivery report. This is not information designed for headlines or financial television panels. It exists quietly inside tables updated each business day, understood by a small group of market participants, who follow delivery mechanics instead of price commentary. 12 million ounces moving toward physical settlement is not routine activity. It represents another entry in a sequence analysts describe as one of the most important institutional shifts ever recorded in the modern silver market. Unlike historical attempts to influence silver prices driven by speculation or concentrated private bets decades ago, what is unfolding now is occurring entirely within regulated exchange mechanisms, visible through documented filings and publicly accessible reports. The significance grows heavier when today's delivery activity is placed inside the timeline. Roughly 90 days before this delivery window opened, an event occurred that most of the market barely noticed. During a late holiday trading session near the end of 2025, a delivery demand entered the CME system, representing approximately 36.5 million ounces of silver tied to thousands of contracts requesting settlement. At that exact time, immediately deliverable registered inventory inside exchange vaults was dramatically smaller than the demand being presented. The system faced a gap large enough to raise structural questions about how paper contracts translate into physical metal when delivery requests accelerate beyond normal expectations. Shortly after that demand appeared, trading disruptions halted activity across parts of the exchange infrastructure for several hours. When operations resumed, the delivery obligation had been moved forward into the March contract cycle. The pressure did not disappear. It simply migrated into the future, carrying its weight into the delivery month. That has now officially begun. Over the weeks that followed, volatility events appeared across silver trading. Margin adjustments increased capital requirements. Price pullbacks forced leveraged traders to exit positions. Paper volatility expanded while physical inventory levels continued trending lower. Each development looked isolated in real time. Yet together, they formed a pattern that now converges inside the March delivery window. Another layer emerged earlier in the year when delivery data showed millions of ounces settling physically. During a contract cycle while open interest unexpectedly increased instead of declining. Under normal futures mechanics, contracts closing through delivery should reduce open interest, because paper claims disappear once metal changes custody. But during that period, new contracts appeared almost simultaneously, as others settled physically. That mechanical contradiction forces an important question into the discussion. If physical silver is being removed from exchange inventories while the number of paper claims continues expanding, who is creating the replacement exposure? And why does price weakness often appear precisely when delivery demand becomes most visible? To understand the scale of the situation, analysts began examining accumulation patterns stretching back more than a decade. Estimates suggest hundreds of millions of ounces of silver may have gradually moved into long-term institutional control during years when prices traded far below current levels. While exact totals remain debated, the directional trend remains measurable. What makes the present moment unusual is not profit-taking after price appreciation. Instead, filings suggest continued acquisition through regulated delivery channels even as prices rise. That behavior implies strategic positioning rather than short-term trading activity. The mechanics behind this process are surprisingly straightforward, once viewed step by step. When exchanges raise margin requirements, leveraged traders often must liquidate futures positions quickly. Those forced liquidations push paper prices lower. Lower prices make standing for physical delivery more attractive for entities with sufficient capital. Metal transfers from weak hands holding leverage into strong hands capable of accepting physical settlement. Over the past 16 months, multiple delivery cycles appear to follow this sequence. Margin pressure increases, paper selling accelerates. Delivery notices rise shortly afterward. Physical inventory moves quietly away from exchange availability. At the same time, another structural signal has been developing globally. Price premiums between Western futures markets and Asian physical exchanges widened significantly, creating incentives for silver to move geographically toward regions willing to pay more for immediate metal. When physical commodities begin migrating consistently across markets, it often reflects underlying demand that paper pricing alone cannot fully contain. Historical data shows that futures markets operated comfortably for decades under one assumption. Most participants would settle contracts financially rather than request metal. The system works efficiently as long as delivery demand remains small, relative to outstanding contracts. But when more participants begin choosing physical settlements simultaneously, stress points appear between theoretical supply and deliverable inventory. At certain moments, the ratio between paper claims and available physical metal reached levels suggesting hundreds of contractual ounces existed for each ounce ready for delivery. Such ratios are sustainable only when confidence in settlement behavior remains stable. Recent inventory reports indicate that registered silver stocks have declined during periods when deliveries increased. Some of the difference has been met through reclassification of existing inventory or movement between eligible and registered categories, processes allowed under exchange rules. However, those pools are not unlimited, and continued drawdowns naturally attract attention from analysts tracking structural balance. There is, however, an equally important counterargument that must be considered seriously. Large banks frequently act as intermediaries for clients rather than principals trading exclusively for themselves. Delivery activity can represent customer demand hedging operations or custody transfers across multiple entities operating under complex legal structures. Public data shows movements, but interpretation requires caution. Additionally, exchanges maintain authority to modify trading conditions whenever market stability is threatened. Margin requirements can change rapidly. Settlement procedures can adapt. Rules exist specifically to prevent disorderly outcomes during stress events. History shows that commodity markets are capable of reshaping operational frameworks when necessary. Both interpretations remain consistent with publicly available information. One view sees deliberate long-term accumulation ahead of a structural transition in how silver is priced relative to physical supply. The other sees normal institutional logistics appearing dramatic when viewed without full visibility into internal operations. What cannot be debated is the data itself. Delivery filings are public. Inventory reports update daily. Margin increases are documented. Contract concentration levels have risen beyond historical norms observed in many commodity markets. These are measurable facts independent of interpretation. As the March delivery cycle unfolds, each new report will add clarity. If delivery demand continues accelerating while inventories tighten, the market may face increasing pressure to reconcile paper pricing with physical availability. If activity normalizes, current concerns may fade into routine operational history. Silver recently traded near multi-year highs while the gold-to-silver ratio compressed compared with past cycles associated with strong physical demand. Inventory levels remain finite. Delivery windows continue opening month after month, and institutions participating through official exchange mechanisms are making decisions that suggest long-term positioning matters more than short-term volatility. Markets rarely announce structural transitions through headlines. They reveal themselves gradually through data sequences that only become obvious after enough entries accumulate in the record. Each delivery notice, each inventory adjustment, each margin event becomes another timestamp inside a larger narrative still forming. The essential question now is not whether volatility will continue. Volatility is guaranteed. The deeper question is whether the silver market is moving from an era dominated primarily by paper liquidity toward one increasingly influenced by physical settlement behavior. If the institutions once associated with suppressing upward momentum are now consistently accepting delivery instead of avoiding it, the implications extend far beyond a single contract month. It suggests preparation for conditions where ownership of physical metal carries strategic importance that paper exposure alone cannot replace. Every investor and observer must decide how to interpret the same publicly available data. Some will see operational coincidence. Others will see deliberate repositioning unfolding step by step in full regulatory visibility. What matters most is understanding the structure behind price movements, rather than reacting emotionally to headlines or daily fluctuations. Markets reward preparation long before consensus forms. The coming weeks will produce more delivery reports, more inventory updates, and more evidence pointing in one direction or another. Those who study the mechanics early often understand market transitions before broader attention arrives. Watch the data carefully, verify sources independently. Study how delivery cycles evolve rather than focusing only on chart movements. Because when structural shifts finally become obvious to everyone, the positioning that mattered most was usually completed long before the crowd recognized what was happening. Stay disciplined, stay analytical, and never allow emotion to replace understanding when markets begin revealing signals that history tends to remember only after the opportunity has already passed.